The crypto market is a very frightening place and at the same time, extremely exciting. You can 2x your money in one day and at the same time, you can lose 50% of your portfolio overnight. And in this video, I'm going to tell you 3 lies you've been told about cryptocurrency. Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. The first lie you've been told about cryptocurrency is that volatility is a bad thing. The truth is that volatility is good. Volatility is the reason that you are here. The only way you can see your asset grow by 100% in 1 year, I'm not even talking about 300, 500, 1,000%, 100% in 1 year, is if it is volatile. Volatility implies that the market is unsure. Once the market is sure and everyone agrees that a certain asset is valuable, the volatility leaves and there is no longer room for gains. And this is especially true for cryptocurrency, but it's also true for any asset, even in the stock market. If we look at some of the best performers over time, Apple, Netflix, the Googles, the Amazons, they all experienced volatility in the early stages when they were still an emerging asset. This is a chart from Apple, and back in 2008, it went as high as, $7, and it went as low as $2, right above $2, more than 50%. And then a few years later, it went as high as $24, and then it came all the way back down to $14, drops of 50% or more. This is across the board, but today everyone agrees that Apple is a great company. So can you still make money with Apple? Yes, you can make money, but at this point, you're not going to do a 4x, 5x, 10x with Apple. You only can do that with volatile assets in their early stages. And right now, Bitcoin and cryptocurrency are extremely early. We are at least 10, 20 years minimum from these assets being accepted. Bitcoin is extremely volatile. It went as high as 20,000 in 2017, came all the way back down to 3,500. But as we know, it has been volatile on an upward trend. And this is what you want. We said that volatility is not a bad thing. What we want, though, is volatility on an upward trend. There is an instance where volatility is bad, and that is volatility on a downward trend. For example, if something is volatile, but it just goes to zero, you're just gonna hold on diamond hands to zero. The key, though, is that it is volatile on an upward trend. So even though it's gonna be very violent along the way, up and down, over a long period, it will go up. And when we look at the crypto market, there are so many different cryptocurrencies. 98% of the cryptocurrencies on CoinGecko, CoinMarketCap, they likely will not be here in 10 years. So just thinking you're gonna buy something and just wait for it to go upward, even though it's gonna be volatile, it'll be on an upward trend, is not always the case. You still need to do your research and find the assets that have shown that they continue to go upwards over a long period of time. So far, the only one that really has proven that is Bitcoin, but there will be others as this market continues to go. So remember, guys, emerging markets, if there is no volatility, you won't be here. So the next time someone asks you, why are you in crypto if it's so volatile? Your answer is, that's exactly the reason that I am here. With all those massive gains and that potential, you need to understand it is a very risky environment. If you need that money in the short term, you can lose it all. So that's lie number 1. Now, going on to lie number 2, knowing what we know, that the market is volatile up and down, we would think, well, then we can just time the market. Even though you might think that Bitcoin or Ethereum or another cryptocurrency will be valuable in the far future, you'll understand that it won't be a simple ride up. It'll go up and down. So every time it goes down, I'll just buy some, and then it goes up, I'll sell some. I'm gonna time the markets. This is extremely difficult to do. Is it impossible? No, there are people that do this, but they treat it as a full-time job. For people that have a full-time job outside of, let's say, trading, that come home on the weekends and try to study trading and then do it a couple hours a day, over the long run, they are not going to do well. You can make money trading, but you need to treat it, like I said, as a full-time job. I think one of the biggest misconceptions about trading is that you go on your Robinhood app or Coinbase and you think you're kind of trading against the market or against a computer, but who is the market? The market on the other side of that screen are real people, Wall Street veterans, crypto whales that have hundreds of millions of dollars in crypto, and they have an advantage that you do not have. You have no way of really competing with these people. And there is a book by Michael Lewis called Flash Boys, which documents the phenomenon of high frequency trading. High frequency trading is a method of trading that uses powerful computer programs to transact a large number of orders in fractions of a second. So not even 1 second, but fractions of a second. Whales and Wall Street have advantages that you do not have. You simply cannot compete. And technological changes and unethical trading practices have transformed the US stock market and now the crypto market from the world's most public, most democratic financial market into a rigged market. And this is true right now even for crypto. Over the long run, you buy, you hold, you wait, it likely will turn out well if you buy the correct asset. But in the short term, you do not have any chance against these whales and against Wall Street and the technology that they have. And this article headline I'm looking at is from 2006. Not a millisecond to spare. We're not talking about a few minutes. We're not even talking about a second. We're talking about a millisecond. And since then, technology has advanced. I'm going to state it again. I know you don't want to hear it. I'm repeating myself over and over. As a day trader, you have no advantage. You likely will lose unless you treat it like a full-time job, 70 to 80-hour weeks focusing on day trading. At best, though, what you might be able to do is swing trading. This is where you maybe buy and trade over a few days, really weeks and even months, right? But day-to-day trading, guys, very, very dangerous game. And I would love to see you guys prove me wrong. There are people out there that do make money trading, but it is a very small percentage. And this brings us to lie number 3, that if you make profits in crypto and you sell those profits, you have paper hands. This whole culture of paper hands versus diamond hands, it's very toxic. If someone buys into crypto, they make a profit and they sell that profit, that is not being paper hands. That is being smart. Paper hands refers to someone who buys crypto and thinks that overnight they're going to be a millionaire. They buy it 2-3 days later, it comes down and they're like, I'm out. This is a scam. This is all fake. I'm out. That's paper hands. Someone that actually makes money in crypto and keeps those profits, that is being smart. And also people that might not be in profits that sell, it's not always paper hands because sometimes people put in more money into the market than they can afford to lose. They over leverage themselves, playing with money that they might need to pay their rent, to pay for actual daily expenses. So in that case, when they sell their crypto, even if they didn't make a profit, that's not paper hands. That is called being responsible. And these are only 3 of the lies in the crypto space, but there are many more misconceptions. So I want to know what you guys think. What are some other misconceptions in the crypto space that I didn't state in this video? Put them down in the comments below. And also go ahead and watch this video on why you will never time the top of the crypto markets. Like this video, subscribe to the channel. Thank you for listening, and I'll see you next time.